Once again, the government has made another mistake in a long line of mistakes. It's because of the government that Silicon Valley Bank was in the position that it was. The reason it owned so many long-term, low-yielding U.S. Treasuries and mortgage-backed securities was because the Fed kept interest rates at zero for so long. And the reason that it chose those assets was because bank regulators kind of push banks into treasuries and mortgage-backed securities because they give them favorable accounting treatment. They don't have to take any haircuts. They don't have to mark them to market. So the government created the problem, and now they're creating a bigger problem with the bailout because this is going to cost Americans a lot of money, not because their taxes are going to be raised, but because the Federal Reserve is financing this massive bailout by creating even more inflation. So Americans are going to pay for this at the supermarket, at the gas station. Their cost of living is going to go way up. If you thought inflation was bad last year, it's about to get a whole lot worse. What you want to have is companies that do well in an inflationary time period with rising rates. We're going to be in that for the balance of this decade and maybe longer. So you want to have companies that have real earnings right now, not in the distant future, that pay good dividends, and importantly, that sell products and services that consumers need to buy. So they have pricing power, so they can raise their prices along with their costs, maintain their margins, and raise their dividends. But I think most important for Americans, I believe the dollar is ultimately going to tank. We're going to have a currency crisis, not just a financial crisis. And so you'll have a much better hedge against inflation if your income streams are coming from abroad because they're being paid to you in foreign currencies. And when you translate them back into weakening U.S. dollars, that means even higher dividends, and that will help offset the rising cost of living that you're going to be experiencing here in the United States as a result of past, current, and future excessive Fed money printing. I like stocks to grow my wealth, but gold to preserve it. But I happen to think that gold is so underpriced right now because investors don't realize how bad inflation is going to be in the future. They've overestimated the Fed's ability to fight it. So I think you can actually make money and preserve it right now with gold, because I think it has to be repriced higher to reflect the reality of much higher inflation. We're not going to go back to 2% probably in my lifetime. It's going to be much higher than that. And when investors come to terms with that, they're going to bid up the price of gold much higher. Well, gold mining stocks are very different than gold itself. Yeah, I look at gold as a store of value, as a safe haven, as just an alternative to cash, right? That's what it is. It's money. It's not an investment. But gold mining stocks are an investment in businesses that mine gold. And so, whenever you make an investment and you're a stockholder in a company, you subject yourself to all sorts of risks, market-related risks, company-specific risks, or political risks. But if the price of gold does what I think it's going to do, these gold stocks are gold mines. I mean, they're going to go way up. I mean, I have, a lot of my own portfolio, my personal portfolio is invested in gold stocks, a very high allocation, maybe about 50% of my investment portfolio, not my net worth, but what I have in my brokerage account, right? About half of that is in gold mining stocks. Wow. The rest is in dividend-paying foreign stocks. Some of them are in the commodity space. My second largest allocation is oil and gas and alternative energy. So I have a lot of energy-related investments, but they all pay good dividends, most of them. I mean, pretty high. And so I'm getting income off these investments, and I don't need the income because I have income working, so I can reinvest the dividends in more stocks. I mean, that's what people need to be doing when they're building for retirement. What Wall Street tells you to do is buy these stocks that don't pay any dividends while you're working, and then when you retire, you can sell those stocks and buy bonds and get some income. Well, what if by the time you retire, the stocks that you bought have crashed and they're not worth very much? Right. And if you sell them, you can't get much income. You see, I built portfolios for people, and we have separately managed accounts too, that you can have an account that's individual stocks too, not funds, and you can talk to my brokers. But I build portfolios that you don't have to sell when you retire. So you have a portfolio that's paying 5-6% dividend right now, right? But it's also stocks that are growing their earnings and should appreciate and grow their dividends. So as you're working, when you don't need the income, you take the dividends and you reinvest them and you buy more stock. Then when you retire, you've got this big portfolio of income-producing stocks that's even larger because you compounded your returns by reinvesting those dividends. Now, when you go to retire, it doesn't matter what the price of those stocks are because you don't have to sell them to retire. You just stop reinvesting the dividends and you live off the dividend income.
That's right.
That's a much better strategy than betting on a Ponzi scheme. Oh, I'm just going to hope these stocks go up, and when I retire, I'm going to hope they're high. What if they're not? What if the price crashes? I'm buying stocks, doesn't matter what price it is, because you're not going to sell. You're just going to spend the dividends because they're real businesses generating real income. And the reason that this strategy is going to work, I think, so well is because I'm buying foreign stocks. So my income is coming from foreign currencies. And if the dollar really goes down, then when you translate those foreign currencies back to dollars, your dividends will be far more valuable. And so, they'll go a lot further when you spend them here in the United States. I mean, we're already paying double for a lot of the things at the grocery store. You look at certain prices and they've gone way up. But this latest round of bank bailouts is going to cause tremendous inflation because where is the Federal Reserve getting the money to bail out all these banks? President Biden made a big deal about reassuring the public that, the taxpayers aren't going to have to pay for this. Well, technically, I guess it's not taxes that are going up in the traditional sense. It's inflation that's going to go up. These bank bailouts aren't free, right? And they're not going to be paid for by the banks themselves. They're getting the bailouts. They're not going to pay for it. It's the American public that's going to pay for it. But the way they're going to pay for it is through inflation because the Federal Reserve is going to have to create out of thin air trillions of new dollars and add it to the money supply.
Yep.
It's going to give the dollars to the banks, and the banks are going to give the Fed their treasuries and their mortgage-backed securities, except they're going to give the Fed maybe 60 or 70 cents worth of treasuries and mortgage-backed securities, and they're going to get a dollar, right? They're not going to get the market value for those securities, which is what we would get if you or I were dumb enough to buy U.S. treasuries, 20, 30-year treasuries a year or two ago when they were yielding 1%. If we were dumb enough to buy them, and then we wanted to sell them, we could only get maybe 70 cents on the dollar or 60 cents on the dollar. But the banks that were dumb enough to buy them, they could get 100 cents on the dollar from the Fed, but the Fed doesn't have any money. Yeah, and the Fed doesn't have any money. It's losing money itself. The Fed is getting bailed out by the Treasury because the Fed doesn't have any money. But then again, neither does the Treasury. So the Federal Reserve has to print money to give it to the Treasury to bail itself out. But all of this means that the dollars that we all hold, I don't hold them because I get rid of them as fast as I get them. But the average American has got dollars, and those dollars are going to buy a lot less as a result of these bank bailouts. So when Biden or anybody in the government or in the media says, oh, the government acted prudently, we've saved the day, we've reassured that your bank account is safe. Nobody's bank account is safe. When the government tells you that your bank account is safe, it's because it's not. And the reason it's not safe, it's not because the banks are going to fail. The government has already said, we're not going to let them fail. Now, that's a mistake. They should let insolvent banks fail. That's how capitalism works. But, we don't have that anymore. We have socialism. And so the insolvent banks won't fail. They're going to be propped up with inflation. But what that means is every single bank account in the country, even the people who are banking with solvent banks, their accounts are going to lose tremendous value because the money in their accounts is going to lose its purchasing power through inflation. So no bank account is safe. Everybody with a bank account is going to experience substantial loss of purchasing power. And so the smart thing to do is to withdraw your money from the bank. Your savings, you got to keep short-term there to pay your bills. But money that you don't need for a year or two or 5 years, whatever, don't leave it at a bank because you're guaranteed to lose because prices are going to go way up. So you should pull your money out of the bank and do something else. Buy gold, buy silver. That's a better savings vehicle than fiat currencies, or invest, get into stocks. I buy foreign dividend-paying stocks for my clients, value stocks. Some people buy real estate, but what you can't own is dollars or, a bank account because you're going to lose.